Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the headlines was Fannie Mae now saying that it will keep its U.S. guarantee as a public firm. I should say President Trump has said that Fannie Mae may keep its U.S. guarantee as a public firm. Ben Elliott is consumer finance analyst for Bloomberg Intelligence, joins us from Washington, D.C. So does this imply that there should be then no change to people's mortgages and the rates?
Well, it's interesting because while President Trump has confirmed that he'd like to keep the U.S. government involved with Fannie and Freddie, and that's a big deal, we still have no details on sort of the contours of the guarantee, and the way that that plays out eventually could have an impact on the mortgage market.
Ben, tell us, just refresh our memory, because I'm going to speak for everyone in our audience. I have no idea how this ownership thing is of Fannie and Freddie. Can you just refresh who owns what and what's President Trump thinking about here?
Yeah, so the federal government owns a senior class of shares that has varying sort of levels of valuation applied to it, but it's probably worth hundreds of billions of dollars. And then the federal government also owns warrants to purchase 79.9% of the common stock. And so the remaining common stock still trades, but it has no voting power and it has limited sort of economic claims on the businesses.
So if that's the case, like, what would ownership or still a backstop by the government to Fannie, but public ownership mean? Like, what is that? That doesn't make any sense to me.
Yeah, so the way the companies are governed right now, something called the Preferred Stock Purchase Agreement is in place. That dates back to 2008. And there's still about $270 billion of liquidity that Treasury has pledged to the enterprises. Individually, actually, so there's different amounts pledged to each company. So presumably what the president is talking about is maintaining the PSPA guarantees, but charging the enterprises some sort of fee in exchange for that liquidity going forward.
So, Ben, as a citizen and a taxpayer, I don't think I want my government really in the loan business to this degree. So don't people want them to get out of this business, sell down?
It's interesting. So Fannie and Freddie actually work extremely well under the status quo. In some ways, I think you might want the government to be in this business. If you look across the globe, the U.S. is really the only country that has this level of liquidity in the mortgage market. The 30-year fixed rate note is something of a unique sort of financial instrument available to U.S. home buyers. And as a result, U.S. home ownership rates are higher than many other nations across the globe. So there is a reason for the U.S. government to be involved. But to your point, they shouldn't be too involved. And we learned that lesson in 2008. And that was actually, so it's interesting, the president tweeted he wanted to keep the implicit guarantee, which is what existed prior to 2008, when basically everyone agreed that Treasury would be on the hook if something happened. We saw that something did happen and Treasury was on the hook. So I think what people would like to see going forward is the government sort of set some strong guardrails around this and say, we're going to backstop this, but only in a very sort of narrow, explicit way.
All I know is if I'm a FIG banker, financial institutions group, if I'm a FIG banker on Wall Street, I'm pitching this deal hard. Think how big this offering would be.
I mean, he's all about fees.
I'm all about fees. You got to get paid.
You can take the banker out of the location, but whatever, something along those lines.
My partnership evaluation at Salomon Brothers, the best thing was he's not afraid to ask for the ticket. You got to get paid.
Yeah.
Talk all you want. Ben Elliott, thank you so much. Consumer finance analyst at Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Happy Wednesday, everybody. Happy Hump Day. I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, politics, and finance through a lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. Retail not having a terrible day today. Macy's stock is up by over 1% after posting better than expected quarterly results. Comp sales falling less than analysts had anticipated. So not as bad is always the win when it comes for earnings. Let's get more on this with Ross Gilbert, Bloomberg Intelligence senior equity analyst who covers retail. All right, let's start with Macy's. Less bad than feared. What are the green shoots here?
Yeah, so I think the green shoots here is that Macy's is showing some traction here with their refresh strategy. When you look at their 125 stores that they've refreshed and they've expanded that to include some additional stores, their comp sales were down about 2%, about 1.9 is the figure that they're using. And, look, Dillard's outperformed because they were down 1%. So they're getting better, but where they really need to improve is on the service levels. Where you also saw strength here is really on the luxury side, and that's Bloomingdale's. Bloomingdale's was up 3.8%, and Bluemercury, which is their specialty beauty growth concept, and that was up 1.5%. So that's where you're really seeing strength, but it's such a small piece of the business. It's really all about the Macy's nameplate. And we still need to see better traction there, but it's getting better and better. And with regard to the tariff hits, it's going to be about 20 to 40 basis points, so very manageable. They directly source about, we estimate that their private label business is about 13 to 14%. That's on a consolidated basis of sales. And so they're sourcing about 27% from China directly. So they have a number of initiatives that are helping them to offset the full effect of tariffs, which you'll see the biggest hit in the second quarter. But for the full year, it's very manageable, in that 20 to 40 basis point impact.
Mary, for Macy's, are they comfortable with their store footprint these days?
So, Paul, they're reducing their store footprint with the Macy's nameplate. With some of the stores that they're closing, they've already closed 64. The total that they plan to close is 150. Wow. So they sort of feel like the go-forward store base is about 350 stores. But right now there's a little bit of a pause, just because of the real estate market and some of the store closures that they have planned for this year. But yes, no, they need to take that store base down.
All right, let's go to the other one, the highlight here, Abercrombie and Fitch. I'm kind of floored by this. Like we saw it with Urban, we saw it with American Eagle. Like these specialty stores, they seem to be somewhat cyclical in nature, and they're crushing it right now.
Yeah, I mean, you can say Abercrombie is crushing it. They kind of are, but I mean, if you look at the namesake brand, the Abercrombie and Fitch brand, that was actually down 10% on a comp sales basis. But in all fairness, they were going against a 29% increase in the prior year first quarter. In a way, you'd say, look, that's no excuse. And certainly they were impacted in the quarter by lower average unit retail. That was because they had some carryover inventory from the winter season. And also it looks like they had a little bit of a miss on their bridal, the wedding business. But where they did have some strength was in swim. They really chased after it. So they've really got a good sort of summer shop going, and they expect that Abercrombie will inflect back to positive in the second half of the year. Where you really saw the strength was Hollister. So Hollister turned in a nice 23% comp sales gain, and that was on top of a double-digit gain last year. So they're really hitting it out of the ballpark, with the teen Gen Z retail customer there.
So, I mean, if I look at the stock for Abercrombie, the good news, it's up 24% year to today. The bad news is it's down 35% this year. Hey, Mary, what are the Macy's and the Abercrombies of the world? What are they saying about the consumer right now?
Yeah, so Macy's is taking a very cautious perspective on the consumer. We think the consumer is pretty resilient. I mean, clearly at the higher end, they're more resilient than at the lower end, and there's some caution in there. But generally, I would say, when we have employment levels, in that sort of unemployment levels in that sort of 4% range, that's really full employment. And when you're employed, you feel good about spending money. So we really think it's holding up. We think retailers are taking a cautious, conservative approach, hoping to be able to beat, and we think they probably can, particularly as we get into the back half of the year and they're able to allay more of the tariff impact as well.
Before we let you go, how are inventories across the board in retail? Have they managed them well enough to avoid a massive discounting round?
Yeah, so that's a good point. I mean, with Macy's, there are some carryover inventory that they are going to be flowing through the second quarter, and that's going to take a hit on margin. Same with Abercrombie. There's going to be a little bit of effect there in some of their inventory in the second quarter, but generally they are doing a much better job. They've invested in systems, data, analytics, and they're also using generative AI, and that's making them more efficient. So we think that inventory levels generally are much better than they were years ago. But yes, they're doing a good job.
All right, Mary, thanks a lot. Really appreciate it, Mary Ross Gilbert joining us. She covers a retail senior equity analyst over at Bloomberg Intelligence. Do you like how I asked that inventory question, which is really a discount question, which is really weird as Alix.
And you did not get the answer that you wanted.
I really didn't. Like, good job for retailers, not good for Alix's shopping.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get back to the market here. Total wait and see when it comes to, say, Nvidia earnings. Let's start there with Meera Pandit, Executive Director, Global Market Strategist at JP Morgan Asset Management. We can take Nvidia in stride, but I wonder what we're going to learn about the U.S. exceptionalism trade/theme once Nvidia comes out.
It does feel like markets are getting a little bit over their head, a little bit beyond their skis here. If you think about Friday's sell-off with some of the tariff announcements of about a 0.7% relative to the reaction when things reversed out by Monday when markets were up, Tuesday when markets were up 2%, it does feel like we are overweighting the good news over the bad news. And while the high water mark for volatility from April is probably in, there are still a number of catalysts that could push markets downward. If we think about earnings at 9% expectations right now, looking pretty unrealistic, the fact that valuations are almost back to where they started the year, or the fact that we've seen to find a new home at around 4.5% on the 10-year Treasury yield, all of these things could start to weigh on markets over time.
So, Meera, one of the underpinnings of this market has to be earnings. And we saw a lot of companies pull their earnings guidance, and earnings have come down. I guess the question is, have they come down enough? Do you still think there's earnings risk in this market?
If we're going to see potentially slow growth this year, recession is no longer our base case, but even slow growth, it's going to be very difficult to achieve what some of the analysts expect in terms of profit growth. So it is still a risk. And although we had an incredibly robust first quarter where we had essentially 7 percentage points higher on year-over-year growth than we would have expected coming into earnings season, that is reflective of the situation we were in, not the situation we may be in. And when we think about tariffs in particular, although the tariff rate has potentially come down quite a bit, we're not out of the woods, and it's still going to be a lot higher than it was last year. So that means domestically and from foreign sources, revenue could slow. And when we think about margins, someone's going to pay for those higher prices. Partially, it could be the consumer. Partially, it could be companies that are therefore compressing margins. So we do have to be mindful of that. In light of tonight's earnings releases, I would also highlight prior to this final Mag 7 reporting, we have seen upward earnings revisions in terms of expectations to the Mag 7 with the reporters so far, relative to downward revisions for the rest of the index. So is it going to continue to be profits, exceptionalism of the Mag 7? That is our big question for the year around profits.
Absolutely, which then also brings us to other assets in terms of, say, the long end of the bond market and the dollar as well. What are we going to learn about those assets after the Nvidia earnings?
It looks like from a Treasury market perspective, and when we think about rates, we've somewhat found this resistance level at 4.5% on the 10-year and perhaps around 5% further out on the curve, even though the risks are still skewed to the upside when it comes to yields. We have less of that downside pressure from potential slowing growth. Although inflation hasn't really caused much of the uptick in yields so far this year, it is still that term premium question mark, which has nothing to do with profits and what specific U.S. companies are doing, and everything to do with debt, deficits, who's buying up bonds, and whether they're more price sensitive than perhaps they were in the past when the Fed was a big buyer. Some of these weak auctions continue to push up bond yields as well. So overall, that environment of rising term premium skews risks to the upside. But the question mark is, when we think about what's priced in the bond market, is a lot of this risk already priced in, and we're finding some of that ceiling from a yield perspective? I mean, despite a lot of the episodes of rising yields we've seen so far this year, most most areas of the bond market, with the exception of areas like the 30-year or municipals, are actually positive this year. So we tend to lose sight of that.
Are you taking credit risk in this market, Meera?
Credit risk is actually not a bad place to be because you are getting good yield in credit, but you're also sort of recession proofing a little bit. I mean, if we don't have a recession and we just have slow growth, you are going to be able to get access to company balance sheets, to company profits, without taking on that same risk of the equity market. Of course, if we do head to recession, we could start to see a little bit more choppiness there. But overall, right now, it seems like a nice balance between equity market risk, but being overly conservative in the bond market because you're getting that income and that access to the health thus far of companies.
All right, Meera, thank you so much for joining us. Really appreciate it. Meera Pandit, Executive Director, Global Market Strategist at J.P. Morgan Asset Management.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's turn to the auto business. Stellantis was in the news today. Looks like they're getting a new CEO. The guy who's running the Americas is going to go over and run the whole shebang here. Steve Mann joins us here. He's a Bloomberg Intelligence Global Autos Analyst. We never talk about Stellantis. Can you remind us who Stellantis is?
Well, Stellantis is an amalgamation of a number of brands, European and U.S., but mostly best known for owning Jeep and Ram trucks.
The old Chrysler.
Old Chrysler, that's right.
And Fiat, right?
Fiat, that's it.
Okay, and that's kind of and they came up with Stellantis. Okay, they got a new CEO.
Yeah.
What happened to the old CEO, and what do we know about the new guy?
Well, the old CEO resigned.
Okay.
Part of it is because earnings were pretty bad, and it may not be 100% his fault. The auto market was weakening. So we have a new CEO. Based on what we're seeing with the stock price, I don't think the market is too thrilled about it. He does have a lot of experience in the auto industry. He's been with Stellantis since 1999, so it's been a while. Like you said, the last stint he was in managing the North American business for a few months, and prior to that he was at Jeep. But it took a number of months for them to identify someone new. But I think the market is just pretty surprised that they went with somebody internal and not somebody external.
So what do we learn about that? Because so many of the problems that are hitting car makers are in some ways completely out of their control.
Yes. In
terms of trade, supply chains, sort of the war on EVs here in the U.S., right? So do we learn that, like, hey, we don't think it's very fixable, so we're not going to worry about someone from the outside? Or is it like, look, the U.S. is in turmoil, we need someone who knows that market? Like, what do we learn?
So there's, they do have issues that's not in their control, but there's a lot of issues that they are in control. So, quality is an issue. I think a lot of American buyers thinks Jeep has kind of fallen off in the quality side. And interestingly, the new CEO, Antonio, actually managed Jeep for about 2 years. So, I think, investor will take that as probably a negative. And then the other issues is morale. Over the past few years, sales have been weakening. They've been closing a lot of plants as a result. Dealers are not very happy with some pricing issues since COVID. So there's a lot of issues that the new CEO will have to kind of address, and hopefully he can turn that around.
All right. So for the big three U.S. automakers in general, what is the consensus on tariffs and how much it will impact their business?
Well, interestingly, Trump has been giving a lot of reprieves and reliefs to various countries and regions and certain sector, but he hasn't really done much for the auto industry. There was some relief, a 2-year relief, but I think he's going full ahead with these auto tariffs, and a lot of companies still don't know how big the impact is. GM actually announced they're going to be a $4 to $5 billion impact this year.
Wow.
Toyota said over between May and March and April, the impact was 1.3 to 1.5 billion. So given these numbers, it's going to be huge.
What about EVs? Is it possible that EVs in the U.S. go the way that EVs went 100 years ago?
It could. It could.
Like, that's not immaterial anymore.
I think there's a number of issues that's facing the EV market. Infrastructure is a big one. It's just not as convenient as people would like it to be. The other thing is the cost. I still think that EV has a place in the marketplace. It's not going to be 50% market share by 2030. We think it's more like half of that, 20 to 25%. And then look, there is a risk to a lower number because of the tariffs and affordability. Some of these EVs are actually made in Mexico. So if you slap on tariffs, that makes it less affordable for consumers.
It's just amazing how fast that part of the industry has turned around.
Turned negative. I mean,
that's what I'm saying.
Yes.
Like that, like just went from like, yep, we're going this direction. The pace is TBD, and now it's like, will this actually survive? All right, great to see you, Steve. Thanks very much. Steve Mann, Bloomberg Intelligence, Global Autos Industrials Research Manager.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.